Lord Abbott stands for one simple thing. We have in our organization a unique ability to anticipate change. What we work at diligently is trying to figure out what's going to happen out over the next 12 to 18 months, and then buy what we would refer to as the undervalued stocks that are going to benefit by that change. Affiliated fund has been around since 1934. For the last 3 decades, we have consistently followed the discipline of trying to invest in the undervalued area based on change. Now, when you hear some crazy guy get up and say that we can anticipate what's going to happen in the next 12 to 18 months, what I'm saying is that we will weave a story that will turn out to be 70 or 80% right. That's all that has to happen. Now, before I tell you what's going to happen, let me lay a little credibility on you so that you'll at least believe 50% of what I'm going to tell you. Early in 1973, we surveyed 523 corporate executives, the CEO of major corporations that were buying in their own stock in the first half of the year. We put a study together anticipating what we thought was going to happen over the next 18 months. We sent it out to 523 companies. We told the corporate executive, we don't need a reply. We thought you'd be interested in the study. We got 108 letters back from corporate America. And from the letters, we knew that the growth stock craze of that time was about to collapse. So if you pick up affiliated fund in July of 1973, when the market was still close to 1,000, you won't find a traditional core growth stock in that portfolio. We owned IBM all the way from 1945. Wasn't there. Kodak, out. Avon, out. Anything that looked like a growth stock, we were out of. Growth stocks in the spring and summer of 1973 were selling anywhere from 45 to 90 times earnings. And when you're looking at a stock market that's selling at 15 or 18 times earnings, it's hard to believe that a group of institutions in the United States would buy something that was selling literally at astronomical prices. It's hard to believe, for example, the Japanese market at 58 times earnings. Well, that's the arena we were in the early part of 73. Between 73 and 74, the stock market went from 1,050 to a bottom of 585. And growth stocks went down to 20 cents on the dollar. So anybody sitting in that arena literally got destroyed. When you pick up affiliated fund in that period, no one was treated to an experience they did not expect. And obviously, they did dramatically better than that downside of that market. It took no genius, for example, in the fall of 75 and early 76, seeing people on energy lines, looking at the numbers and realizing we were more dependent on Middle East oil in October of 75 than we were in 73 when the Middle East turned off the oil spigot, to recognize there was going to be an energy policy developed in this country. So again, look at affiliated fund. And what you find is a loading up of energy stocks in 75 and early 76. And then in the middle of 1980, when everybody said, hey guys, we're at $38 crude, we're going to $50 crude, everything is great in the energy area, we walked away. That's the next collapse that came starting in 81. You look in early 81, or I should say in December of 81, we wrote a position paper. Inflation was running at 13 and 14%, and in the position paper, which we sent to our clients, we suggested that inflation was about to come under control. And for the rest of the decade, inflation would stay at 3 or 4%. And if we're wrong, it'll be 2 and not 5. Guess what? That's still going on and nobody believes it. The wrinkle in the bond market suggests that people don't believe it. I'll try to fill you in as to why that's so obvious as far as the next 3 or 4 years are concerned. But I guess the major call that everybody heard loud and clear occurred during May, June, July, and August of '82. We suggested in the first week in August in Business Week that we were about to embark on the greatest bull market in the history of the country. The Dow Jones was 765, and we said before the decade is over, the market will sell somewhere between 3,000 and 3,500 on a Dow. Not many people believed this then. They wanted to put us in a soft room. I think most people believe it now, but they're frightened of it. But that's the reality of the credibility that I like to lay on the table. We've just been through 60 months of a bull market, 5 years of it. The market has tripled. It's gone from 765 to 2,545. Every individual that has watched that develop has said to himself, I'll wait for a correction to get in. If I heard that in '82, I heard it in '83, '84, '85, I'm still hearing it. In that 60 months, there is no 3-month period or no 6-month period where the correction in the market has been more than 5 or 7%. That has been the window of this bull market as of today. So when people are waiting for something, we don't accommodate them. That's something you learn very early in the business. When everybody is on that corner, get off the corner. It isn't going to happen the way they expect it to happen. Sure, there'll be a wrinkle in this bull market. We'll get a correction sometime this year of 10 or 12% and spook everybody like we did in the bond market in May and June. But it's a non-event in a bull market, a non-event. I'd like to suggest one thing before I go into what's going to happen in the next 12 to 18 months. And if you don't believe anything, please believe what I am about to tell you. You live in the kind of environment that we're going through only twice in your entire working life. This kind of a phenomena of a bull market will only occur twice in your lifetime while you're working. So to think this is going to go on indefinitely and that there is no piper to pay at the end of it and that there's a long period before we get another one of these, you're dreaming. Absolutely dreaming. This occurs twice in your working life. Please, please understand that. Now, let me switch gears and talk a little bit about what's been happening and what you should be looking for next. There's been a tremendous confusion in the system the last 2 or 3 months. And the confusion relates to the fact that the dollar collapsed dramatically, far more than anybody expected, and it all occurred primarily since September of last year. It had been going on since February of the year before, but the real collapse in the dollar relative to the yen or the Deutschmark occurred since September of last year. And while that was going on, everybody got spooked by inflation. They looked at commodity prices going up a little and they said, oh my God, inflation's going to come back. We're going to see 12 or 13% inflation again and interest rates are going to go to 13 or 14 and my God, the party is over. Really got frightened. Mutual fund sales in the month of May were off 40%. That's how spooked people got. At the same time, interest rates themselves, which had come in '82 from 14.5%, almost in a straight line, to 7.5. Bounce back 125 or 150 basis points to 8.75 or 8.5. And everybody was shocked. And while that confusion was going on in the inflation arena and the interest rate arena and the dollar arena, all of a sudden there was word out of Congress and a tremendous concern about protectionism, because all of a sudden Japanese were having us for breakfast as far as our trade deficit was concerned. And everybody got frightened to death. The bottom line of all that is that's the culmination of what's been going on since September. You should have anticipated that that was going to happen. Every one of those events were in the cards. You see, since September, and incidentally, for you folks and the folks listening on our TV, go back and ask for a tape from Lord Abbott in September of last year, and this is what you're going to hear on the tape. We are about to embark on a hardball policy with Japan. The game is going to change. No more are we going to go through 9 months of 5 and 6% real growth in this country in terms of the purchase of cars and textiles and appliances and video TVs and everything else. No more are we going to go and steam up the system by dropping interest rates and have everybody borrowing and going in at 5 or 6% and then wake up in September and find out of the 5 or 6% growth in real final demand, we get 1 and Japan and the rest of the world get 5. We're going to do something about it. And guess what? We were doing it for 7 months. That's why we had the collapse in the dollar. That's why interest rates spooked and inflation moved. All because of what we were doing it. Let me explain it in a more simple way. You've all heard about the G7, the 7 industrial countries, or the G5, and they're sitting down in meetings. Since September, it's been a G1. Not G5 and G7. We have been controlling our own destiny about what's going on. Now go back 7 months ago and look what's happened in terms of the evidence to show that that's exactly what we've been doing. We never touched the discount rate after cutting it 3 times in the first 9 months last year. Fed funds stayed between 6 and 6 3/8. Final demand for goods and services in this country in the last 9 months has been growing at zero growth in demand, final demand, whereas it was going at 5 or 6% the first 9 months of the year. So all of a sudden, you're seeing things happen in Japan, and you're saying, oh my goodness, I didn't know that that was going to happen. All of a sudden, they're cutting their discount rates not once or twice, but 4 times. All of a sudden, Japan, instead of having a money supply growing at 5% a year, it's now growing at 10% a year. They're beginning to stimulate their economy. All of a sudden, they're talking about taking billions of dollars from the government and moving it into the housing area and moving their economy along. Underneath, pick up paper after paper, and you find that all of a sudden their imports are going down because they're not servicing a 5 or 6% growth. They're servicing a 0 growth in this country. And at the same time, while all this is happening, the unemployment is building in Japan. So what we're in, folks, is the 8th inning of the ball game. The change is upon us. The confusion that you've been looking at for 3 or 4 months was due to what we were trying to accomplish. The next step is the pressure on Germany and Europe. That's where the next action is going to be. There is no way in God's green earth that we're going to be the locomotive for the rest of the world for the rest of the decade. The rest of the world has to get their act together. And that's exactly what's going to happen. So, when you look out over the next 12 to 18 months, I've been saying this, incidentally, for the last 6 or 9 months. When you go out into the rest of '87 and into '88, Don't be surprised that the trade deficit changes. You shouldn't be surprised that underneath exports have been improving almost every single month since September. We shouldn't be surprised that the economy isn't going into a recession like everybody thought in January and February. We shouldn't be surprised when corporate America that's operating in the Pacific Basin starts saying, hey, I'm getting out of there and I'm going to start the manufacturing back in my own country. We shouldn't be surprised that Japanese have plans to have 7 auto plants manufacturing in this country by the early part of '89. All of this is part of the pressure that's developed here. So the economy is going to move along because all of a sudden exports are going to get a lot better. Imports are going to be coming down. We're going to recapture some of the growth that we lost in the last 6 years. We lost $55 billion worth of capital goods orders because the dollar was here instead of here in 6 years. We're not going to lose another $55 billion. That game is over. At the same time, you're going to see an inventory build going on in this country in the next 6 to 9 or 12 months. And the inventory build isn't in cars. It's in industrial material. Again, we're focused, as usual, on the wrong area. And so since September, I've been saying that all of a sudden corporate America is going to get its act together. It's not going to look backwards and worry about who's going to come and take them over and constantly buy in their own stock and then set up all these crazy proxies with golden parachutes and green mail and poison pill. They're going to finally say, hey, let's attend to the business. Let's start growing again the way we did in the 50s and 60s. There's only one way they can do it. The dollar has given them a little bit of a window on competition. Now we've got to do what we did before. We have to put investments into the individuals left on the payroll. We have to become far more efficient and more productive. So what am I saying to you? What I'm saying to you is that for 5 years we've heard about a consumer-driven economy. '82, it started in the fall when everybody cut the interest rate on cars down to 9.5%. And we've been riding a wave of consumption all the way through '82, '83, '84, '85. We are now going to move on what will, quote, be termed over the next 3 years, an industrial-driven economy. In other words, we're not looking for the consumer to buy 5 or 6 or 7% more cars and houses and shirts and suits and dresses and what have you. We don't care if he stays down at 1 or 2% growth. The real growth in the economy is going to come from the industrial side. The real growth in the economy is going to come because corporate America is finally going to take the money that they're using to buy in their own stock and start putting it into new plant and equipment and getting far more competitive. That's part of the nature of this bull market, which you'll see as we describe it towards the end. Now, the other thing that is happening that we've been talking about that no one really understands yet, but they're getting close. We are moving, as a result of this industrial-driven economy, to a literal explosion in earnings. In other words, we've been watching earnings almost fall off the end of the table, except in a consumer area. Whether a drug company or a beverage company or an auto company or a cosmetic company, they've been pouring money. But if you look at a U.S. Steel or you look at a Phelps Dodge or an Alcoa or a DuPont or what have you, for a number of years there, they were going nowhere. And the reason they were going nowhere is because when a dollar was dramatically higher, they lost share of market outside this country like you wouldn't believe. And everybody had been on a survival mode. The purpose of early retirements, which everyone in this audience has been influenced by some relative or friend since '82, is a reflection of corporate America getting its act together. More important, about government letting them do it. We would never have gotten away with it 10 years ago. But all of the early retirements, the layoffs, all of the people that took advantage of the tax law by closing facilities before December 31st last year, the just-in-time inventory, all the tightness in the system is now beginning to come through in the earnings statement. Everybody is surprised at the earnings in the June quarter. there are more pluses way above what people expected. People were running around expecting, for example, Caterpillar tractor to earn 50 cents in a quarter, and they came in with $1.20. Blew people's minds. Everybody was figuring that Reynolds Metals, which earned 50 cents a year ago in the second quarter, but might earn 75% this year, 75 cents this year, and they came in with something like $1.15. What that is the cyclical dynamics of organizations that have their act together. We're into a huge move in earnings. How huge? 87 and 88 combined earnings will be up over 40% in terms of the S&P 500. So you're going to literally see a tremendous move in earnings. And incidentally, dividends are going right on the same track. You picked up the paper the other day and you saw Merck where their dividend was increased 45% in one shot. That's only the beginning of people that are going to develop cash flow now and not know what to do with it other than plant and equipment. So you're going to see a huge, huge move in terms of corporate earnings. Now, as you move from a consumer-driven economy to an industrial-driven economy, there may be a lag. All of a sudden, before the industrial really takes off in a big way and exports take off in a big way, maybe the consumption side comes down a little quicker. And so for a 2 or 3 month period, everybody will see the system slow down a little bit and get nervous. Don't get nervous. It's in the textbook where we're going. We're right on the absolute track in terms of the economy and in terms of corporate earnings. So don't get spooked by an article in the Wall Street Journal. Just ignore it. The pattern is clear on the direction we're going. Now, in the last 5 months, 2 items have come up consistently. One of the things you folks should know, when you're in a bull market, you read it the other day, we climb a wall of worry. What that means basically is that once a bull market gets started, nobody can believe it. And each 500-point move in the market, everybody finds 5 or 6 things to worry sick about for fear they might have to give back the 500 points. Not worrying about the idea of the next 500 that I might miss, but worrying about losing the 500 they just got. And we've been doing that all the way from 765 to 2,500 plus in the market. And guess what? We got 2 worries right now, even though the market's at 2,500. And when I tell you the 2 worries, and we don't have to be concerned about them, by September, I'll tell you the next one. It's so simple, it's ridiculous. Everybody is still concerned about the inflationary pressures. They're concerned that when they read in the paper, they see interest rates jiggling up a little bit. Maybe the bond market goes to 9.25, 9.5, I don't know. They're worried for fear the inflation's going to take off. Inflation in this country is under total control. The reason I wrote the paper in December, with the help of everyone in the shop at Lord Abbott, I bounced it off them, explained what I wanted to write, why I wanted to write it, and as soon as I got enough people to believe in the shop, I was ready to roll. You see, inflation in the United States, 2/3 of it is labor cost related. In other words, the reason inflation went to 13 and 14 and 15% is labor was always asking for more to stay ahead of inflation as it was going along. And somewhere along the way, somebody had to say, stop, no more. And the poor bunny we just tried to tar and feather was the guy that brought it all about. When President Reagan fired the air controllers in the summer of 1981, in effect, what he said was, let's get labor costs under control. You have the green light to roll on it. Anybody that took the time to go to a library in September, October, November, and December of 1981 would have saw things happening in the labor arena that they did not see happen at any time in the entire post-war period. You will never see General Motors sell a plant in New Jersey to the employees for $1. But you saw that in the fall of 1981. You would never see corporate America get into an early retirement program of blowing 12 and 13% of the labor force out of operation simply with a package that put them into a Carvel stand in Florida. We aggressively got the cost down. Corporate America knew whatever they did, there wasn't somebody in Washington that was going to say, stop, you can't do that. And so inflation came under dramatic control over a 5-year period. Now everybody's frightened to death of inflation. Wages, first quarter of the year, both in the manufacturing and in the service side, the lowest in 26 years. There is no way labor costs are going to get out of control, at least until we get into 89 and 90. Now, if that's all I was hanging my hat on in terms of talking about inflation, I'd be a little nervous. But there's another phenomenon why we're not going to get inflation back until the end of the decade. You see, in the 70s, when inflation was blowing out to 13, 14, and 15%, anybody in the bond market thought each time it went up, it was going to roll over. So when inflation was 13%, interest rates were only 10. They never got up to the inflation rate. You always lost money with every high-quality bond you bought because inflation was always 3 or 4% ahead of you. You lost 3 or 4% every time you bought one, all the way up in the 70s and early 80s. Now what's happening? Interest rates are leading inflation. You scare somebody into the fact that inflation might pick up, and all of a sudden you're looking at an 8.75% bond. You tell me that the scare will go on for the next 3 months and that inflation might be 6 or 5, 7%, and I'm going to tell you that the bond market's going to 11. What does that mean? As soon as interest rates perk to a certain point, the whole system slows down. The demand for credit, the demand for product, everything slows and inflation goes right down. Falls right off the end of the table. So we're not going to get inflation. We've got the discipline of the interest rate structure, and people should not have been spooked by the 125-point move in the interest rate thing. As a matter of fact, somewhere in here, and I don't know whether it's 8.75 or 9 or 9.25, that's the highest interest rate you're going to see for the rest of the decade. And before the decade is over, interest rates are going to be 5%. So rather than being concerned about it like you were about getting into the equity market, you're being given the opportunity in the bond market and you're not taking advantage of it. And guess what? When you get the opportunity in the equity market, you won't take advantage of it either, because you'll always know that there's something to be spooked about. So the key is to know that we're not going back to the inflation of the 70s and early 80s, and interest rates are not going back to 12 and 13 and 14%. That the next major change in interest rates is down, not up. And don't try to call it on a monthly basis. Just explain what's going on. And that's the key, incidentally, when you get into this business. When you get a move of 125 or 150 basis points in terms of interest rates, or the stock market goes down 200 points, big deal. 10%? That's when you earn your money. That's when you should be calling the client, not having him call you, explaining to him what's going on and showing that you know what's going on, rather than him calling you and listening to your voice bubbling about being worried about what's going on. Your real value is to keep the guy in the game. The worst thing you can do in a bull market, the absolute worst, is lose your position. You've got to stay in the bull market and enjoy it. I mean, I walk around this country. I was in 5 cities in the last 3 weeks. I mean, you would think we were in 1974 and the market was 565. The market is 2,500. Bond rates are in 14 and down at 8. And people are spooked. Makes absolutely no sense. Now, the second thing that worries people over and over again, everywhere I go, they're saying, hey, look, the consumer has spent all he can spend. I mean, after all, he's borrowed as much as he can. We can see his installment debt is going down. He pays no attention to the new credit cards he's getting from, Valley National or Citibank, in St. Louis or wherever. And so he's not borrowing money anymore aggressively. So if the consumer slows down, my God, the economy must be going to fall off the end of the table. And everybody's worried that the economy will really go into a full recession. Guess what? Ain't no way it's going to go into a recession. It just isn't going to happen. Now, the reason it won't happen is pretty simple. Could we get one quarter in which the economy slows to a minus number? Sure we could. I don't rule that out. But there is no way we're going to get 2 minus quarters in a full-blown recession. That just isn't going to happen. You see, last October, the federal deficit in this country was something like $221 billion. And everybody said, why, it's out of control. Nobody in Washington knows what they're doing. And the bottom line is nobody really looked at the numbers. Nobody looked, for example, in December and found that in the government they spent, in terms of rate of increase in spending, it was the lowest rate of increase of any quarter in the entire post-war period in the December quarter. The Graham-Rudman, even though it isn't law, has been working. The attitude in Congress is, let's cut the spending. And it worked. And they slowed the spending down. Now, that doesn't mean it won't pick up a little bit during the election year. I won't argue that. But the bottom line is there's religion down there in terms of not letting this deficit get wildly out of line. And then, lo and behold, we changed the tax law. And then all of a sudden you pick up the paper in the middle of April, and then pick it up in May, and now we'll pick it up in June and July, and everybody's, oh my God, the government is getting more money into the till than they ever expected. We only thought we were going to get, in April, we only thought we were going to get a certain number, and all of a sudden the government's getting $8 to $12 billion more in than they thought they were. And all of a sudden, the same thing happens in May. And they say, oh, gee, what's going on? The only thing that's going on is the deficit is going down. All of a sudden, we're waking up right now in July, and the deficit now is running towards $155 billion. We're literally taking more than $70 billion out of the deficit. Now, we did our homework. We said, okay, let's assume that somewhere out over the next 12 months, there is a recession. Maybe 2 minus quarters in the December quarter, in the March quarter, or maybe in the March quarter and the June quarter. This is what we did with the energy thing when we plugged $50 into the equation and found out that the oil companies were going to have 50% of the earnings in the entire country and knew it wouldn't happen. Let's go 2 minus quarters. You know what that does to the deficit? Takes the deficit to $290 billion. Does anyone listening to me really think in an election year we're going to have a $290 billion deficit? In whose lifetime? You've never seen that happen in your lifetime. I'm not going to see it happen. So the likelihood is that the deficit is going to stay on the mend. And any slowdown in the system, the highest priority in the land is make sure the deficit doesn't get out of line. They'll do that even at the expense of letting the dollar roll a little, or even at the expense of getting a little bit of an inflation scare. We will not have a recession. And we wouldn't even have it even if there wasn't an election. But the fact that there's an election coming up, there is no way in heck they'll let it happen. Have you noticed what I've been trying to tell you? Have you noticed the consistency of the pattern of what I've been saying to you? When you're in a bull market, problems disappear. That's the nature of a bull market. You will get something, one of the most valuable things you can do is when you develop a client base, the first time the client starts worrying, write down what he's worrying about. Because 6 months later, it's going to be a different worry. It won't be the same worry. It's our nature to worry. When we have money on the line, we constantly worry. But in a bull market, things turn out right. And think about it. It's pretty obvious that that's what happens. We all got worked up over Reagan and Ollie North and everything like that. We had all this gibberish going on since last November. Now they can't get it off the TV fast enough. That's the nature of a bull market. One of the characteristics at the top of the cycle is that the federal deficit will be pushing under $50 billion. One of the characteristics at the top of a market is that the trade deficit turns out to be a trade surplus. We're shipping more out than we're taking in. One of the characteristics of the top of the market is every time you pick up the Wall Street Journal, you're going to have to go to page 52 to find a negative. There won't be any negatives in the paper. That's when you're going to have to get scared. As long as the client is worried and constantly worried, you're home free because you're providing a service and holding them into the game. Okay. Next major worry, take it to the bank. Starts in September, it's the election. We won't know who the candidates are, but everyone starts next September worrying about the election, who gets into office, whether he's a Democrat or Republican, whether he's competent or incompetent, and what changes will come to policy. We will wax on that theme for 12 solid months, watching the market go forward. That will be the major worry in this country, starting in September. Now, before I get into the final evaluation of the market, let me, for the benefit of everyone here, switch gears a little. One of the things that has to happen when you're doing the kind of work we're doing in anticipating change is that as you see the potential for the change, you've got to move the portfolio in the direction of change. What we have been saying to people since last September, it's already completed in our portfolios, incidentally, for the most part. Maybe we got 1 or 2% more to change, but not much. What I'm about to tell you is what's going to happen in the next 3 years. You see, the market is literally going to change leadership right before your eyes. In other words, if you're in a consumer-driven economy, and the PepsiCos and the Johnson & Johnsons and the JCPenney's and the Upjohns of the world are in a front leading position in terms of the market. A lot of them have gone up 3- and 4-fold, incidentally, since 82. They'll go up very, very little for the rest of the decade. The leadership in the marketplace is going to be related to an industrial-driven economy. The leadership in the marketplace is going to be in the capital goods area, in things like machinery companies, Ingersoll Rand, Caterpillar Tractor, combustion engineering, companies like that. It's going to be in technology, companies like IBM, Texas Instruments, Hewlett-Packard, Motorola, companies of that nature. And then it's going to be across a broad spectrum of industrial materials. It already has started in a fair way in chemicals and papers because they were the first to benefit from the change in the dollar in the export arena, but it's going to spread right across the system, not only into aluminum, but copper and steel and all kinds of miscellaneous metals. It's even going to get into the companies that get involved, for example, in maintenance work in terms of plants. It's even going to get involved with vendor companies that serve drinks and everything in plants because plants are literally going to hum in the next 3 years. We're on to a major, major new trend. Now, starting in September, the way I tried to express it so everybody would understand it simply was to say it this way. You're going to make more money in the next 18 to 24 months in Alcoa, Aluminum Company of America, than you are in American Home Products. I started saying that in September. In September, American Home was 95. Alcoa was 35. Pick up the paper this morning, and you will find American Home at 95. But you won't find Alcoa at 35. You'll find it closer to 60. So the name of the game is being in the right areas. IBM is going to make a lot more money for the shareholder than International Flavors and Fragrances. USX is going to make a lot more money for people than Upjohn will. It's just that simple. There is no way that those companies can go up fourfold and the USX sit dead in the water, or IBM fluctuate between 130 and 160. The leadership comes in the other area. It means that IBM's going to 300 or 350 before the party is over. USX is probably going up to 70 or 80 before the party's over. Ingersoll Rand will go right up to 100 without batting an eye. And what it'll be that the earnings will develop because they'll benefit from exports, a major investment cycle in this country, and a whole movement in that arena. So that's the way we're going. And the energy area is another one that's going to be big. And the way the energy is going to play out, very simply, is it won't be under the control of OPEC like it's been for the last 5 or 10 years. What happens is industrial activity picks up outside the United States. They're the biggest users of Middle East oil in Europe and Japan. And when supply-demand starts kicking in, then the price structure gradually ticks back from $20 or $21 a barrel towards 24 or 25 in a very orderly way, non-inflationary way. And so that while no one owns energy in a big way now, they'll own a lot of it before the cycle is over. That's the way the game is going to get played out. Okay, let me wrap up with a couple of thoughts. Number one of the things I think I try to do this at every time I talk to people, they ought to be reading all the time. They ought to read good books. What I'd like everyone to read if they get a chance, it's called The Intuitive Manager. It's a blue book with white lettering, and it's written by a man by the name of Roy Rowan, R-O-W-A-N. And what basically the book is about, it's the right side of your head. It's the intuitive, creative side as opposed to the analytical side. The market is irrational. You better get to use the right side of your head, your gut. Your gut feeling will be far more important than anyone that's punching PE ratios and return on investment for you. The market doesn't work that way. Okay? Read the book, understand how you develop the right side of your head. Most people are left-brained. You know, they don't do very much on that side of the head. It's a very good book. Now, the reason people are upset with the market being at 2,500 or the bond market being at 8.5 or 8 3/4, majority of people are upset because they haven't participated. Most people have been away from where the action is. Last year in the mutual fund industry, for example, record year, over 200 billion of sales. The whole industry in size was only 35 billion in 74. So 200 billion of sales is enormous. But the bottom line is that 80% of it was in fixed income and only 20% was in equity. So people generally that you will be exposed to have not participated in this equity market. They just have not bought common stocks. Now, up until the summer of last year, it made all the sense in the world. Because until the summer of last year, bonds tracked equities in terms of total return pretty closely. Last year, when we finished the year, bonds, total return were up something like 16 or 17%, but equity was up 23 or 24%. We were saying to everybody last year that you're coming to the stage where equity is going to dramatically outperform bonds for the rest of the decade. Doesn't mean you won't make money in bonds, you'll just make so much more in the equity market. Well, so far this year, the bond market is down, and equities are up 30%. The individual reinvests his interest income on a bond. He's looking at total return. He's not buying a bond because he wants the income to buy bread and potatoes or the local newspaper. He's reinvesting it. So when he sees his total return going down, he's going to want to do something different. It's in the history book. It's in the history book. If you don't bring the individual into this market at 2,500 or 24 or 23 or 26, if you don't bring him in this market this year, he's coming in at 3,500. He's going to create the top of the market. And if you think a 125-point hiccup in the bond market means anything, think of what's going to happen when he has to go through the kind of experience we had in 73 and 74. So the most important thing to do is, all right, the guy wants to buy bonds, fine, but balance them. Get them into the equity market. The rate of improvement in earnings is going to be so phenomenal that in the course of '88, when you look at the end of '88's earnings, right now the market's selling at 13 times earnings. It's not expensive. And so the key is to get the individual into common stocks. Now, when you look at all the data around you, it's pretty obvious that there's more left to the bull market. The secular trend of interest rates is still down. We're going to 5% in a long bond. Just takes a little longer. And hopefully, it does take longer, because if we didn't get the interruption in the bond market, and if we don't get the interruption in the equity market, the whole thing would be over before you sat at a desk to work. So hopefully we get a little wrinkle and pull it out to 89 or 90. The new tax law, I don't know, I mean, I would assume people have looked at it, but basically the new tax law in effect says, guys, the only way you're going to make money is by being in financial instruments. If you think you're going to buy a piece of real estate and inflation is going to bail you out and Uncle Sam is going to pay you as a tax shelter, it's over. Not only are you getting a tax break with real estate, but there's no inflation. There's no movement in value. It doesn't mean you're not going to make money in some real estate, but boy, you've got to be so much more careful about real estate you buy. If I took all the real estate in the country and I put a valuation on it, what I would find is in the last 6 years, it's gone up 4% per annum while the market has tripled. That's the real world. And if you go and play in the Virgin Islands in California or play in Florida, you're going to look at absolute declines in the value of your real estate before the party is over. So you don't want to play that game. The tax law says, guys, I'm paying you to go into financial markets, whether it's bonds or common stocks. And that's the direction people are going to go as we go through the rest of the decade. Now, there should be some correlation between this environment and preceding bull markets. And there is. There is. If I go back to December of 1968, the first time the market blew out over 1,000, and I took all the individuals of the country, and I said, okay, I only want to look at their financial assets. I don't want to look at the Queen Anne table or the Japanese ceramics or the condo in Florida. I just want to look at checking, savings, fixed income, and equity. What I find in December of 1968, all the individuals of the country had $1.9 trillion. You know how much was in equity? 45%. Now let's roll forward. Same four areas: checking, savings, fixed income, and equity. Maybe different individuals. Maybe we have our father's wealth, or we've created our own wealth, or whatever. But the bottom line is the number as of March of this year is $8.7 trillion. Not 1.9, 8.7. How much is in equity? 30%. How much is in fixed income? Over 40. Guess what's going to happen in the next 3 years? The 40's going to 20, and the equity's going to 40, 45. In other words, the juice of this market in the course of the next 3 years is not the institutions. There's no more cash flow in corporate pension accounts. It's the individual. He's going to get excited about this thing. He's going to see things going right, and he's going to want in. And he has the money to do it. So we're going to be on a huge roll in here. And so all I'm trying to suggest to you is that the juice is in place. The markets are the cheapest in the world, in the U.S. Interest rates in Japan are 3.5% on a long bond. Here they're 8 3/4, and we're frightened to death. Does that make any sense? Not in my judgment. Equity market in Japan is 58 times earnings, and then as I scan Europe, it comes down, but it gets nowhere near 13 times earnings. That's why the foreigner is going to end up in here. He's going to come over and buy our stocks. He's going to come over and buy our plants. He's going to come over and build plants here. The whole 9 yards. So we're into a unique period. We're into an exciting period. Can there be delays? Yes. Can there be an interruption in the bull market? Yes. But don't let it shake you. Enjoy this thing. Remember, as I said before, you live in it twice in your entire adult life. Thank you very much.